Hi, everybody. My name's Matt Ohrt. Thanks for your time today. My background is a little bit unique in that I worked for employers. I've always had an entrepreneurial spirit, but I worked for employers for just short of 25 years, and I was leading human resources. And so the first 2/3 of my career, I worked for some really cool companies, Toyota Motor Manufacturing in Kentucky, and traveled around and worked my way up and so forth. But honestly, the first 2/3 healthcare I saw as really very boring, and maybe it is, you know. But I didn't know much about it. But the employer healthcare part, the employer health plan part. So I'm still not a medical background, but what was interesting is that in 2016, I took a role as the VP of HR for a company called Merrill Steel in central Wisconsin, a family-owned company with about 1,000 members. Really interesting company. We sent away steel for cool stuff like the Raiders Stadium and the Vikings Stadium and the Bucks and all sorts of cool things, and then lots of very boring things like Amazon warehouses. But when I got there, we realized that we had a healthcare issue, a health cost issue, is that the owner said, you know, last 5 years it's been 9% a year compounded. We've been absorbing the cost. We haven't been passing it on to our employees, but we need to, is there anything we can do about this? And so I had their support. I didn't know what I know today, but we dug in and we started, it was already self-funded, but we started reconstructing from scratch the self-funded plan. And so there's a big misconception out there about self-funded. If you ever heard an employer say, you know, we tried self-funding and it didn't work, that's actually a misconception. What was missing was a medical strategy, right? How you fund your plan doesn't determine whether you have cost. It just determines how you fund it. So anyway, so we built that up and we built it, and it had like 30 plus pieces. But the first step was DPC, a partnership. We were their first client. And so this was all when we were kind of pioneering, 2016. 5 years later, fast forward, they had 37 employers they're working with, about 8,000 members. We had saved about $5.5 million from our trajectory we were previously on. We had increased accessibility to same or next day, plus referrals in a week or two. And we had increased the quality of care. And so, as you might imagine, that got noticed in central Wisconsin. It drew a lot of attention. We won, the awards just started coming in, regional, state, national. We kind of got on the map, and I left there, and then this health plan we designed, I had co-founded a company to go and help other companies do that. It's called Self-Fund Health. And then also founded a healthcare best practice group, which started out with like 4 people, and then published a book in July of last year as a guide for doctors, for employers, for advisors to do what we did, to create a free market healthcare plan. And when publishing in the book in July, it was 1,200 people in this healthcare best practice group. 9 months later, it's 3,400 people, to give you an idea of what's happening in Wisconsin with providers and employers. So really cool. So that's my background. So hopefully I can share some insight. If you have an interest in working with employers, I would say it's the same community. You can go and get them family by family, or you can get them in groups of 50 or 100 or 200 right through the employer. They work a little bit differently maybe. The employer is probably going to give you a more consistent payment and more volume, but in the same, it's taking care of people. My wife and I also are very community-oriented. We care about the community deeply, and we hate to see our community run over by big healthcare. So we're foster parents, and we do what we can there. So we've got just a brief amount of time. I think it's roughly 15 minutes each, so this will be kind of skimming, but please reach out to me on LinkedIn or matt@selffundhealth.com. Certainly would like to get to know you, and I love networking. So maybe some insight in terms of how to reach companies, right? That's always like the big question. Who do I talk to? What do I tell them, right? So I will tell you this. It could be any of those 3. It could be HR, CFO, CEO. I would say this, though. I'll tell you a quick story. As the VP of HR, I had the custodial team reporting to me, and the vacuum broke. And in about 10 minutes, I think, when we called the rep, we had established which vacuum was the one to buy. It was exactly the one that broke. We had fixed it 4 times. So I'm going through this purchasing process for a $500 vacuum. Anybody had to do this? I'm not, right, where you're having like, here's 3 quotes, da-da-da. And I'm spending 2 or 3 hours that afternoon, and then I realized, and I'm having to get all these approvals, even as in my role in the executive team, and I realized I had just signed the stop loss. I had signed the stop loss agreement that morning, and all I needed was a nod from the CFO for $700,000, right? So one of the points here is that for employers, I think this is fair to say almost every employer, there are rare exceptions, healthcare is off the radar. The broker comes in, they talk about it maybe a month and a half in advance, maybe 2. And they make decisions and they move on and they go back to running the business. So I think that's just important to know. I'll talk about more specifics, but even though it's probably on your mind, right, all year round, it's on my mind now. This is not on the top of their list. They're not really giving it its due importance. The healthcare industry, just a quick point there in the time here. The key players, the hospital, insurance, and the brokers, kind of on the industry side. One, I can't get into the details, but all 3 of those entities want the prices to go up. So imagine that it is, right? Hospital, seller always wants the price to go up. We would expect that. Insurance, there's a thing called MLR, medical loss ratio. They get to keep 15% of the premiums. So 15% of a smaller number is less than 15% of a bigger number. So they're actually incentivized through the ACA, and then the broker gets commissions based on premiums. So that's just something to know. I can't dig in the time here, but that's important to know. As you're dealing maybe with brokers or advisors, DPC is a little safer. They won't lose any commissions from that. If they implement a full plan, if you start switching TPA or PBM, they're going to lose commissions. So just kind of aware as you're working with advisors. But if you have some forward-thinking advisors in your area, those would be great people to work with. So in general, I won't spend much time here, but I used to think this for the first 2/3, that a claim is a claim is a claim. So I thought hospitals are all goodwill and they're all the same, and it doesn't really matter. Our cost is mainly determined on whether people get sick. There's truth in that, right? Whether you have some serious illnesses. However, a claim is not a claim, is not a claim. We can now find $600 MRIs instead of $6,000. We can find $20,000 joint replacements instead of $100,000 that are better in quality. So shopping for healthcare becomes a theme. Employees are extremely frustrated. If there's a voiceless, powerless person here, it's the employees. Maybe you feel this way on your health plan in some regard, right? You come into your enrollment meeting, you have no say. All the decisions have already been made, and here's what it is this year. More times than not, here's the bad news. I did that for, as I said, the first 2/3 for like 15 plus years. That gets old. After that, I got in front of our employees and I said, you know what, we're going to do some things. This is nonsense. I'm starting to learn here how this thing really works. And I'm going to stand in front of you. I'm not going to put the broker in front of you. I'm going to stand in front of you. I'm going to tell you if we had a good year or a bad year. Either way, I'll tell you, but I'm going to get in front of you. And we had, Meryl Steele's on their 7th year in a row now of premium freezes, right? So we did well. We didn't know we were going to do those things, but we said we're going to try. In general, you say, who do I call? HR, CFO, CEO? Stereotyped a little bit, so be careful, right? I don't want to go there, but I was maybe the exception, but HR generally is change resistant. If somebody's unhappy in the company, HR gets blamed. They're like, people are unhappy. It's an HR issue, right? It's probably a leadership issue, or maybe the person's just off, whatever, right? But I would say as MDs, a lot of MDs here, you have power in that and influence in that MD degree, right? In that education. So I would, if I were you, I mean, this is maybe not a, right, this is opinion, but I would reach out to the CEO, CFO, they will probably respond to you. When they see an MD, whenever I see an MD, I'm like, yeah, I'm going to talk to them. So they'll bring HR in, and then they'll tell HR to go, and HR will go, but I don't think HR is going to initiate in most cases. There's always exceptions. In general, so I mentioned the book, so this is the guide. And so this tells step by step of how I did it. And it's a free market approach. But in general, employers, especially the benefits people, they don't see the numbers. They don't really look at the numbers, which is kind of odd. The CFO's looking at the numbers. The HR leader's looking at the network and the deductible and the premium. They're experts at the game that insurance has handed them. But that's a losing game for employers. Employers are the only buyer in this whole thing. All the money flying around is employers and employees' money. So it's a losing game. So you're going to need to play a new game, right? How do we shop for a car? What's the best deal? What's the best quality? What's the best value? How do we shop for groceries? How do we shop for a TV? Which restaurants do we choose? If we don't like it, we go somewhere else. Healthcare industry, they've shut down this. You have to shop in network. You can't go anywhere else, and you don't even know the price, right? So we've got to open up shopping. We should know the price before we buy. So last slide here. In the model that I used, DPC is the heartbeat, meaning the center. So everything is built around the medical director of the plan. It can't be done without DPC. Then we go to DSC. Maybe you knew this, maybe you didn't. Direct specialty care. The money, there's two big wins for the employer in a model like this. DPC, we're going to bring back primary care to what it was like, 30 years ago, where you could actually get time. You know more about this than I do, right? You can have a relationship. You can be accessible outside of the office, all the things we've talked about. Direct specialty care referrals is actually where most of the money savings is from the employer plan side. So this is what you want to be savvy at if you're working with an employer. It's best to be in their plan, not outside of their health plan. So that's part of the design. But, right, why refer to a $10,000 MRI when there's a $600 one down the street? Surgery, we have now oncology, we have cardiology, even heart surgery. So all these things are available. 70% plus of the specialty referrals can be shopped. That's where that's how you save millions. So those two things. How am I doing on time?
You got 4 minutes.
Couple of minutes. Okay. Yeah, so short, so I had to kind of skim, but we'll take questions at the end. But yeah, I would say if you haven't considered partnering with an employer, I mean, it's the same people, right? But if you want to scale, that's a really good way to do it. But there's employers needing help. And the employers are driving toward a cliff. They're still not aware yet. They're not pumping the brakes. They're not turning the wheel. And they need help. So you are, as DPC, DSC, you are the future of healthcare as we open up this free market. All right.
So I'm Dr. Shane Purcell. I'm a family physician in Anderson, South Carolina. Been doing DPC for about 8 years, working with some employers in doing that. And I've spoke at this conference in the past and some other conferences. So this is the only picture you get on this whole presentation. So enjoy this one picture on this awesome, sexy, cool topic that we have to talk about today. So we're going to talk about, Matt was kind of giving you guys a brief five things employers, you guys should know about employers, but I'm giving you 5 things you guys need to think about as you go to see employers. What can you share with them? What they need to know about DPC, because you're going in, most of them have no clue what DPC is. As an employer, they don't know who you are. Most physicians don't know what DPC is. So just quick 5 things. DPCs are fiercely independent. Anybody agree with that pretty much? They're pretty much want to do their own thing. They've left the system. You've spent a lot of time and energy to get out and do your own thing, and they don't want anybody messing up their system and what they got going on, right? So they're fiercely independent. So I heard this quote. I was listening to a online lecture or a podcast at another free market conference, and a broker actually said this from the back. I thought it was Carl, but it was a broker. I couldn't see who it was. It was a guy, advisor, excuse me, in the back, and he said, the best thing about DPC docs is they're independent, and the worst thing about DPC docs is their independence. Because they're resistant to change. They don't want people in there micromanaging their practice. Hey, I need this data. Hey, you got to do a prior authorization. You got to do this. And so advisors, the real people, the brokers don't know how to handle DPC because we don't want to do all that crap, right? So they have a hard time dealing with independence. So employers should kind of need to know that up front. we're sort of focused on 100%. Not really. I mean, 100% of my time is not focused on patients. I have a practice I have to run too, right? And you got employers you got to deal with. But when you're sitting in front of the patient, it's all patients all the time in front of that patient, not somebody else, right? So employers need to understand how independent we are. And that's a good thing most of the time. The bad parts, we just have to work together and communicate where we can work it out, right, Matt?
Absolutely.
Number 2, we're militant about saving patients money. People are just crazy. Like a DPC doctor will do anything to save people money. Hey, if you drive across 45 minutes, I can save you an extra $100. So, and we've spent a lot of time, right? We have individual patients that we've spent a lot of time finding out where the best MRIs are. Where's the EKG? I heard somebody talking about finding a Holter monitor for $75 for somebody. We've already done a lot of this work, so they need to know we have all this information. So let's sit down and talk about, when I meet with Matt, and he's the employer, he's the advisor, he's putting the plan together. Hey, I can get an MRI over here for $600. I can get this for $600. Our labs are cheap, our meds are cheap. So you need to share all that kind of stuff and be upfront, transparent about the pricing. You know, we're just really, really crazy about saving people money, right? So let them know that. Let the employers know that, that's your focus. Number 3, we're entrepreneurs. If you're going to open up your practice, you are going to be an entrepreneur, right? It's your practice, it's your baby. There's been a talk earlier today about starting your practices, and it's not easy, and starting it and building it and growing it. But entrepreneurs, we're able to think outside the box. How many physicians in here have been told you can't do business? Physicians have heard that before. Docs don't know how to run a business. You can't run a business. Or my partner, when we started this 8 years ago, was told by the bigwigs at the hospital, you'll fail. You're never going to make it because you don't know how to run a business. And now we're 8, 9 years into it already. So as an entrepreneur, you got to think outside the box. So when COVID hit, we were already ready for COVID. We were doing virtual care already. We never closed our office. We actually hired people. People were losing jobs, and we were hiring people. So we're adaptable because we're entrepreneurs. We're open to business risk. We're ready to communicate with people like Matt, sit down at a table and say, hey, how can we expand? How can we grow? You know, what other services can we provide for you guys? So we're not locked in as a physician working at some hospital system that has no room to budge on anything. So we're able to think outside the box and be entrepreneurs. We're a strong advocate for saving employers money, and this is what Matt loves to hear, right? So as an employer, they want to save money. And we've done a lot of the legwork already. Some of the things we've done in our office to save money, cost-effective quality care for patients is we brought in a nutritionist, no cost to anybody. So we pay a nutritionist, anybody, employer-assigned patients, independent patients, anybody in our office can see our nutritionist for nothing. And so we were able to add that service on, dietitian nutrition services. And it cost the big employer didn't have to pay one dime more to get that service. Another one we were able to do was a deal with a sleep doctor in our community who went straight cash. So it's a cash-only sleep clinic. And we basically worked a deal for our county municipality. So they have for $500 basically, they can get 2 visits to the sleep doctor and a home sleep study done all for $500. And then they continue to manage them over time, like once a year. They can get an in-house sleep study for $600, which is dirt cheap. So we're able to sell them on other savings for the employer and ways we can save them money, save the time and energy. So communication and education is a huge, huge, huge component, as Matt was saying. You got to get in a room and sit down with the employers and the builders of the plan and say, okay, I've got a place I can save you guys money here. Or they have to come to us and say, hey, we're getting killed on these GLP agonist shots. Our county came to us two months ago and said, one medication, they're on progress $300,000 for this 1 year for one medication for weight loss. And they said, we can't do that. We're not going to continue to do that. Let's sit down. Let's make a plan, right? We have, because we're entrepreneurs, we have flexibility, adaptability. We can look at a cost-effective way to work with our nutritionists, to work with therapists in our community, to craft a plan to work to lower the cost of that weight loss, another weight loss plan besides GLP, just giving somebody medicine, right? So working in communication and education, because employers don't understand that. They don't understand that we can help them get through the system. There are ways, there are cost-effective ways to get through it. So being a strong advocate for saving on money and communication is huge. So another big one is DPC is not traditional fee-for-service primary care. As Matt was saying, most primary care, most employers don't understand how healthcare works. Nobody understands how it works. And so they think we're scamming them. Everybody thinks DPC is a scam, like, oh, yeah, sure. Right, you're going to spend 45 minutes with them. Sure, it's only going to cost me $75 a month, right? And so they think it's the same old fee-for-service. They've been lied to many times. They've had brokers come in and tell them, oh, it's the same old story. Your broker shows up once a year, and they say, man, it was tough. You were going to have a 12% raise in your premium this year, but I got it down to 9 for you. And so they've been lied to over and over again, so they don't believe that this DPC thing is real. They think it's the same old stuff. So you got to kind of educate them. It's all about education, how you're different, more time, more access, and how that improves cost and affordability for their patients. So you got to get them to try to taste it a little bit, the old taste and see kind of adage. If you're working with employers, sometimes people would say, how do you get your foot in the door? One good thing is, if you get in and talk to the company, just have the owner come and be a patient. Have the top level people come a patient. If you really want to be ballsy, find out the company has 100 employees. Find out the 10 worst, most sick patients in the company and say, I'll take all 10 of them. Bring your worst patients and let me take care of those worst and see how much money I can save. And so try to get a few, let them taste it and see. But it's different than fee-for-service, right? So these are the things I would think about when you're working with advisors, brokers, whoever the heck the employer is trying to put in front of you. Employers, the question I like to ask is, do independent physicians matter? Does it matter if your company has 500 employees and you're trying to craft a plan? Do you want your patients going to see the big box hospital system primary care doctors? Or do you want an independent physician who's thinking outside the box, who's trying to do it the best they can? I hope that they're thinking about independent physicians. Even an independent physicians group that's not part of the hospital system, right? Because the hospital system is going to send everybody where? Hospital system docs are going to send everybody to the hospital, right? They're saving no money. So think about those questions. Those are 5 quick points that you guys should think about for the employers. And I think I did that pretty fast.
You did.
So I think we're good on that. And we'll take questions at the end, and we've got another group coming.
My name's Angel. I'm one of the co-founders of Virtuous Benefits, and this is my counterpart, Neer Patel. I'll get started as he kind of sets that up. So if this is your first conference, or if you come every year, no doubt you've noticed that the DPC movement is growing, and really there's nothing that's going to stop it. You're also noticing that employers are taking notice. Some are already reaching out to DPCs. Some DPCs are already working with them. That's going to increase over time as well. And so our presentation today is, as you're kind of getting these new opportunities and you're explaining to potential employers why it's important and some of the new tools that are available, we're going to take the first part of our presentation to help you and help the employers understand how their current insurance works, because once you start telling about the new tools that are available, they're going to say, I don't even understand how Blue Cross makes money or how it all works. You're going to confuse them. So we're going to take the first part of that to give you some pointers on what to talk about. demystifying employer healthcare insurance for DPCs. That's our goal. A little bit about myself. So I've been in the industry for about 15 years. Feel free to read the bio. But what I have seen in my career is that when a company invests in their employees to have a comprehensive benefit plan, the company thrives. Because if you invest in your people, they're going to work hard for you as well, and your company's success is going to thrive. So I have seen that happen year over year, and with DPC and some of the plans we'll talk about, that only magnifies even more.
Hi, everybody. I'm Neer Patel. I think many of you know me, but I see a lot of new faces in the room, so that's super exciting. So this is my family, Katrina Iqbal, and then our two kids, Ari and Kian. They're 7 and 8. They're the reason why we do everything that we do. My wife is a family physician, just like many of you. And 9 years ago, after a couple of years of working urgent care, after finishing residency, she came home from work and said, "I'd like to quit medicine. I don't want to be a physician anymore." And I think all of you know the reason why she said that. And so that was kind of the time we decided we have to figure out a different way, and learned about DPC from a friend of ours who had just opened his DPC practice about 6 months prior in Austin, Texas. And we just kind of took a leap of faith. She quit her job, and we opened Direct Med DPC in Austin with one tiny room and 0 patients that we started in February of 2015. So this is our practice. We have grown it since then now to 7 physicians and 4 locations across Central Texas. So we have Austin, Texas, Lakeway, which is a suburb of Austin, and then a couple of towns in between Austin and San Antonio. We have an office in New Braunfels and an office in San Marcos. And these are our amazing physicians that all work with us. Susie Lessing, Shirley Metz, Katie Keller, Beth Just, Janelle Sosa, and Travis Simmons. We have never put out an ad for a physician. We advocate for DPC as much as we possibly can. We do a lot of podcasts, we do a lot of social media and things like that. And so a lot of these physicians, well, all of these physicians have come to us kind of out of the woodworks. They've seen us on different social media things that we've done. They've seen our website, and they just kind of reach out and they're like, "I'm miserable in the traditional system. I love what you guys are doing. Do you have a place for us?" And we basically talk to anybody that comes in, that wants to potentially come to DPC or even learn about DPC, whether they want to work for us or not. And we help educate them. And then if they're the right fit and, basically a genuine person that wants to really provide high quality care to their patients, then we kind of talk to them about where are you located, are you looking to be employed, and let's build the office around you. And that's kind of how we've grown our practice thus far.
So how does traditional health insurance work? And we're specifically talking about 2 things, fully insured and network plans. Again, you ask the average consumer that has Blue Cross, they say, "I don't know how Blue Cross works. I have my card, I show up, I give my copay, and that's that," right? That's all they know. And it goes up every year. So the first thing we're going to understand is, what does the term fully insured mean? And so basically at its core, it's just a fixed premium that covers employees' medical expenses, right? Pay your premiums, don't ask any questions of where the money goes or how it's spent. You get access to all these doctors. That's essentially what fully insured is. The other thing that I wanted to talk about was, how do they come up with the number, right? Because it keeps going up, and you might be thinking, well, do they just make it up? How is it this expensive every time? Now, it depends on the size of employer that you have. So if you're under 50 employees, they get 4 points of data from you and your employees. Everybody's name, date of birth, zip code, and gender. And they base the rate based off of those 4 points. Now, think about that when you know about insurance, and that insurance at its core is just passing risk from one entity to another. So with those 4 points of information, they don't know if somebody's 50 years old and healthy, or 50 years old, 1 foot in the grave, the other on a banana peel, right? So do you think they're going to overcharge you or undercharge you? Every single time they're going to overcharge you, right? Because that's their model. Now, when you're over 50 employees, they'll get the same information, but on top of that, they'll look at claims history, your renewals from last year, just to, again, assess the risk. But the claims data, as you've been finding out through this conference, it's actually overinflated. And we'll talk a little bit more about that why. Now, network. Everybody, again, knows the big carriers. BUCA is the acronym that everybody uses, Blue Cross, Cigna, Aetna. And so when you think about what their sales pitch is, it's always, hey, you have access to this big network, right? Are your employees in different states? Perfect. We have providers in those states. Do you want to give your employees a choice or tell them where to go? No, I want to tell them that they have a choice. Perfect. We have a PPO plan for you. That's the sales pitch. But what they don't tell you is what those contracts actually say, right? How many of you either have been or are willing to go on a blind date? Not many, right? Fun fact, in college, Josh Umber only had blind dates. That's the only way he could get it. I can say that. We had bourbon last night. We connected. But you're signing blind contracts, right? That's the part they don't tell you. And they don't tell you how much things cost. Because again, like a little magician, they're saying, look over here, and not showing you what they're doing, that sleight of hand. So that's what network insurance is, right? They tell you one, but they don't tell you what's going on behind the scenes.
So we might wonder when we have a health plan, not every year is a bad year, right? There's years where people don't get sick, they don't go to the hospital, they don't have major surgeries. So who keeps the money in those bad years, right? We're still paying the same amount of premium, and actually, in fact, we're paying more premium every year. So when a company has a good year, who keeps the money? The answer is the carriers keep the money, and they distribute it between their executives and their shareholders. They don't provide us any credit on the good years for the bad years to help offset things. They just keep all the money. And then we also want to understand, when you're an employer, whoever is advising you and helping you assemble your health plan, you want to understand how they're compensated. Anytime anyone's advising you on anything, you need to understand how they're being compensated to make sure that their incentives are aligned with yours. In the traditional system, brokers are essentially compensated a percentage of the employer's premium. So every year when the health plan goes up, and they usually go up 10 to 30% every single year, the broker, when they come to 11 months later, they come talk to you about your renewal rate, what's going to happen next year. 100% of the time, it's bad news. We're going up another 15 or 20% this year. But they're getting a raise at the exact same time that they're delivering this bad news to the employer. So again, we need to make sure that whoever's advising, their incentives are aligned with the company's objectives. In addition to that compensation, there's also kickbacks, basically, that come from the carriers. Blue Cross, United, if you sell 5 more of Blue Cross plans this quarter, we'll send you to Hawaii. If you sell 1 more United Healthcare plan by the end of the year, we will give you a $5,000 bonus, right? And so all of that happens behind the scenes, behind the curtain. Those are things that people usually never talk about.
So where does DPC fit in this model? And the actual answer is it doesn't, right? Because one, employees are saying, well, I'm already paying for this insurance that I barely can afford or can't afford. I can't pay for your membership on top of that. Or I'm already paying for a plan that includes primary care. Why would I pay extra for this, right? Especially from the employer's perspective, this is a very huge expense. Under payroll or after payroll, this is the highest expense that an employer has. So they can't afford both. And if for whatever reason they may be able to, you're actually rewarding Blue Cross's bad behavior or United's, because you're making them look good while the DPC is doing all the work and getting no credit. So it doesn't fit in that model. So now we're going to shift over to what you can introduce to an employer and really where it starts making sense for everybody involved. Self-funded health plans. And you kind of heard that throughout the conference, so we're going to go a little bit into the weeds of, well, what is a self-funded, what's needed, how does it work? Because again, you're communicating this to your employer, or if you're working with an advisor, you're going to want to at least understand where they're going with it, because again, you're the one that's typically going to bring this to the table. First part of a self-funded plan is how do they rate the premiums? We saw previously how it was done. With self-funded plans, there is some more extensive underwriting. If you're under 50 employees, there's usually health questionnaires involved. And one thing that I always educate employers on is every single one of your employees, for the most part, shows up to work every day, which means they're fairly healthy, right? And so you're going to get a favorable rate just by going through that process. What we've seen in the few years that we've done this, 15 to 25% less on premiums from the gate just by going through this process. Because again, everything is about risk. If now you're giving the insurance company the data that they can properly assess the risk, they're going to lower the rates because of that.
So the other thing that we have to help employers understand is this network that they're being sold, right, by all these hundreds of thousands of brokers all over the country. They're selling them the Blue Cross network, the United network. We have to help employers understand, is that network actually helping you or is it hurting you? And the way we do that is by helping them understand what happens behind the scenes in a network and how do insurance companies actually make money. So most of us think they charge us a monthly premium and they make their money off of that monthly premium. That's actually just the baseline starting point where they make money. The real place that they make money is through their networks. And they penalize us for going out of network. They make us think these doctors that are out of network are ridiculously expensive. So we're gonna double your deductible if you go out of network, and that's just to keep you within the network so you don't get gouged by these crazy doctors. Basically, everybody in this room is out of network, and we are the most affordable and high quality medical practices in the country. So we all know that that's not true, right? But if we go out of network, they cannot gouge us and the health plan. And that's the reason why they force us to use a network. So an example that many of you know is an MRI costs $300 to $500, the actual cost, right? But when you use your Blue Cross or United card, they bill $2,000 or $3,000 for that MRI. Blue Cross has pre-negotiated contracts with all these providers and facilities around the country, and we don't have any legal right to see what those contracts say. And none of those contracts are in our favor. But when we sign up for a Blue Cross or United plan, we're signing up for those pre-negotiated contracts, and we lose all of our negotiating power. And so when someone gets an MRI with that network-based plan, Blue Cross is still cutting a check to the imaging facility for $200 to $300, and then they're paying themselves the other $2,000, and they don't have to ask permission to do that because they're managing and administering the plan. So this is the reason why we need to remove the network, because now we have all the negotiating power, and we essentially are able to pay the true cost of what everything costs for every single thing in healthcare. So another important point that you want to help employers understand is employee education is extremely critical to the success of these types of plans, right? We're removing a network that everybody's used to and that all providers and facilities around the country recognize. And we're giving them a health insurance card that says their company's name on it, and it doesn't say Blue Cross's name on it because their company has designed the health plan, not Blue Cross. And so, you want to make sure you're working with an advisor that understands all of this, that heavily educates on DPC. They understand DPC. Hopefully they're a DPC patient themselves, right? Because we have to help these employees understand. Everybody in the country right now that says they have the best doctor that's not in DPC, they've basically found the best of the worst, right? And obviously I'm not calling doctors bad doctors. It's the system that's forcing them to practice a certain way, but they've found the best of the worst. And so they don't really know what they don't know. And so we have to help them see the light, and we have to educate them about DPC, and we have to make it their idea to want to join our DPC plan. And so we do that through very heavy education continually with the employees. And then we also do the same education around this removal of a network, right? So as an agency doing these types of plans, you have to be full service or DPC-like in that when we set up health plans and we educate employees, we do all the education about why DPC is so amazing, and that should be the first place you go for everything that you need. And then if the DPC refers you out of their office for something, make sure that we're the first phone call, text message, or email that you send to let us know that you want to go to Dr. Jones for cardiology or whatever other specialty, or ask us to help you find a specialist if you're being referred out. Because if you go and show your insurance card at this facility that says your company's name on it, most likely the person at the front desk is going to say, we've never heard of this insurance, we don't take it. And then the employee is going to be frustrated. They're not going to like us. They're not going to like our health plan. And so we are very upfront with employees when we do our education. We let them know we are basically, you have your DPC doctor and we're your DPC agency. So reach out to us when your DPC doctor tells you you need to go outside the office for something. We will get your first appointment taken care of as far as scheduling so that the office understands how everything works with your insurance and you don't have any frustration. Everything goes smoothly. And then every time you have to go back, everything's good. They already know how everything works, and it goes smoothly.
So how do you get DPCs or employees to sign up for the DPC plan, right? A lot of times they've had a doctor for many years, or they're just used to what they're used to, and they don't want to choose it for whatever reason. Well, you want to incentivize them, right? And you've also heard that throughout the conference. You want to give them imaging, labs, generic medications. Doing this for as long as I have, the moment I finish an employee presentation, for the most part, that employee just forgot everything I just told them, right? Because they're at work and they're going to, perform their job. So you have to give them that incentive so that's what they remember. Oh, the DPC plan is free. I get full access to the doctor. That's the one I'm going to try, right? So that's what you want to do to, again, steer the employees to the right plan. Because if you don't, the plan may suffer a little bit. The employer may say, well, we're not saving as much as I thought. Might as well go back to Blue Cross. But this way, they're going to not only see the value in DPC, but they're going to get a return on that investment. This is a very important part of a self-funded plan. Stop-loss insurance is what we call the real insurance behind a plan, because this is what's actually paying for all the catastrophic things that employees get insurance for. Surgeries, right? Hospital visits, expensive treatments, chemotherapy. That's what the stop loss covers, and there's no limit to what the stop loss will pay. So that protects the financial risk from the employee and the employer, so they know ahead of time what their risk is. And so there's never an opportunity where, oh, this cancer treatment ended up being $2 million, we're going to have to ask you for more money. Not going to happen if you have the right stop loss. The other thing that happens in a self-funded plan, and I'll give you a visual on the next slide, is there's something called a claim fund. So part of the premiums are getting divided and paying for some of these smaller claims, right? With stop loss, you want to set a threshold depending on the size of your company, 10,000, 50,000, 100,000, depending on what that is. So anything under that is paid by the separate bank account that we set up. And if that money ever runs out, let's say you have a lot of small claims, the stop loss will also kick in. So you want to have those layers of protection for your employer. So again, there's no situation where they're financially at risk for something. This is a visual of that. Left-hand side, fully insured, right? I pay my premiums. I never see that money back. They don't tell me how it's spent. It's gone. On the right side, now you get to see some transparency, where the money is going, how it's being spent. So claims fund is one. Then we have the stop-loss premium. You're also going to want to find an independent TPA. Somebody has to administer all of this. You got to have vendors that are paying providers or physicians. So having an independent TPA will help. And then in regards to medication, you're going to want to have things like international sourcing, somebody that helps with manufacturer's assistance. All of these things are vendors that provide these services. So the TPA kind of just handles the coordination of all of that. That's just a visual. And of course, what does an employer want to see? They're changing entirely what they're doing. This is what they want to see. They want to see a return on their investment.
So how do we help the employer understand that the DPC membership is not only there to provide super high quality care to their employees and keep them very healthy, but it's also there to help them provide a return on this investment. We teach the employers when we educate them that DPC, again, it's not only getting your employees very healthy in a proactive, preventative way, but it's also protecting all of this money, right? So as Angel talked about on the last slide, basically you have a monthly premium. We build DPC into that monthly premium at a very as high of a value proposition as possible, so usually around $100 a month. You want them, so you've got a monthly premium, and what's happening is about half of that monthly premium is going into this separate account that's paying for the small claims. The other half is going to pay for the stop-loss insurance that has no limit, that's covering all the really bad things, the hospitalizations, the cancers, the major surgeries. And so this small claim fund, it's not technically small, especially if you're a larger company. If you've got 50 or 100 or 200 employees, it becomes a very large claim fund. And DPC Care handles about 80 to 90% of all the employees' needs in a very high quality way. And none of that hits the insurance plan or that small claims fund as claims, because those small claims are paid for by that small claims fund. So DPC is essentially steering all these unnecessary claims away from the health plan and protecting that small claims fund money from being used unnecessarily. But we do have it there to be used when it's necessary to use it. And so that's how we help the employer understand how they're getting a return on investment through their DPC. And because I'm so intimately involved in the DPC world, and I understand kind of what we want from a physician's perspective in DPC, when all these executives get together in a room and the benefits advisors and the executives are all kind of figuring out the plan and start cooking up crazy ideas about all this nonsensical reporting that we don't want to do, I'm able to shut those things down, right? Because we don't need them. And I'm able to advocate for the DPCs and make sure that we build the plan in a way that we don't have to do all the nonsensical things that, that really provide no value. All we need to do at a renewal meeting is show them 2 pieces of paper. One is a very detailed claims report that shows everything that happened through the insurance. The other one is a DPC usage report that gets spit out of most of your EMRs in 30 seconds, right? Just showing an anonymized way of how many text messages, emails, lab results, prescriptions, all those things. We show them those 2 pieces of paper. One shows almost no activity on the claims report usually in our groups. The other one shows all the activity in DPC. That's all the reporting we need to show them once a year, that you have no claims because everyone's using DPC. So that's kind of how we do things. And then you also want to help employers understand this is a long-term strategy, right? What employers are used to doing at renewals is what we like to call the healthcare dance in the traditional system. So, as I mentioned previously, the health insurance costs in the traditional plans are going up usually 10 to 30% every single year. So when the broker comes to have the renewal meeting with the executive team and explains to them, we're going to get another 20% increase this year, usually everyone starts to panic. How are we going to afford this? How are employees going to afford this? Let's just be reactive and start doing things that can lower the premium, like narrowing the network, going from a PPO to an HMO. All these things that are essentially reducing the quality of care and reducing the access to care for employees, just to try to save a few dollars on the premium. That's not a long-term strategy, right? And so we want to help employers understand this is a long-term strategy of self-funding without a network with direct primary care. We're going to look at this from a 3 to 5 year standpoint, and we're going to help show you after year 1, we're now going to have a large amount of money in this claims fund that's going to roll over to year 2, and you're going to start year 2 with tens of thousands, sometimes even hundreds of thousands of dollars in an account that it can be used for healthcare spending. Now, when we're starting with $50,000 or $100,000 in an account, the employer can do all the things that they've always wanted to do for their employees. They can start paying more for employees. They can start paying for employees' dependents. They can start including more services free to or no cost to the employee. They can also do things to help them become their own little insurance company with this large stop loss hanging around in the background, right? They can push up the stop loss limits, which is basically, you guys can think about it like a deductible, right? If you have a deductible on your auto insurance that's $500, you're going to pay a lot more every month. But if you push it up to $5,000, you're going to pay a lot less every month. So we do the same thing here. Once we know the utilization after year 1, we can advise our clients that, hey, let's push the stop loss deductible from $50,000 to $75,000. That's going to bring our costs down. And we already have the money in the bank to fund any catastrophic things that happen that doesn't hit the stop loss limit. Yeah, go ahead.
So as these opportunities start coming to you, because you may have a patient that says, hey, I'm a business owner, I'm a CFO, how can we make all of this work out for my company, right? You're already hearing stories of that throughout the conference. Now as a DPC, you're in the driver's seat. You get to pick what advisor or broker you want to hire, right? So we're going to give you some tips on how to vet, questions to ask, because if you go to any advisor in your town and say, hey, I got a new group for you, do you want it? Everybody's going to say yes. But is it the right advisor for your group? A couple questions. How well do they understand DPC, right? Do they know it as well as you do? Are they a DPC patient themselves, right? Neer pointed that out. Think about it. If they're going to promote, sell, encourage DPC, and they've never tried it themselves, are they going to get high participation, right? Think about some of those things and ask them, right? It's basically like a job interview, right? If you're going to be my advisor for this group, what are we doing?
You also want to understand how much, where does their approach lie, or where does their strategy lie, right? Or how much fully insured business are they doing, basically? Which fully insured is kind of the traditional system we talked about, where there is no transparency around the money. You're just paying it. It's going into a black hole, and then you got to pay 20% more every year after that. So you want to understand from the advisor's book of business, are they doing those broken plans, and how much of their business is with those broken plans? And that will help you understand whether that's somebody that's going to be aligned with your objectives and helping do what's genuinely right for a company and for your practice. You also want to understand, is the advisor that you're working with, are they okay with the pricing that you're charging? Because these are your practices. You guys are the bosses. You call the shots, right? And you create the prices. And so are they okay with incorporating your prices into their employer's health plan? Or are they trying to ask you, will you take $50 for an adult, or will you take $30 for an adult? Are they trying to devalue what you're doing, right? As we mentioned in this presentation, the DPCs are doing the lion's share of the work in these health plans. And you guys know what you do, right? You do the lion's share of the work with any patient, whether it's an employer patient or not. You're the front lines. They're coming to you for everything. You're seeing them, you're evaluating them, and then you're kind of deciding what needs to happen from there and what the plan should be. So your work should never be devalued, and you want to make sure that advisors are not trying to do that.
How are they compensated, right? We saw on the traditional side, the higher the premiums, the more money they get, the more bonuses. How is their comp structured within your self-funded plan? Do they get paid more the more expensive they get? Where is that incentive? You really want to ask those questions. So again, you're in the driver's seat. You're picking them. That's what you want to understand. The last slide, this happens almost with any group. There's a learning curve. It's a very emotional process for a lot of companies. They start off with some denial, some anxiety, like, are we really leaving the network? I've had this for 20 years. This all my employees know. Are you absolutely sure this is the way to do it? Then as we start going through the process, and they say, okay, well, I like the DPC. I like what they're doing. Now they're starting to maybe accept it a little more. Then at the end of your renewal, when everybody's used it, they see the ease of it, how much money they save. Now they're enthusiastic. Their energy is there. They're going to start referring their families, their other employers, other owners that they know. But it's a ride. It's not going to be smooth sailing the whole time, but you want somebody who's committed to the process, and you want to encourage them every step of the way, that you're putting all the tools in place to protect their employees, and you're not just going to do what the other advisors do and just show up once a year and say, hey, thanks, we'll see you on the renewal. Again, you want an advisor that's helping every step of the way, so the employees know that, this person is actually listening to me. They're actually following through on a promise. That's something that I've learned in the insurance industry. Regardless of what policy I sell and what insurance company is on that policy, if I sold it to them, they're going to call me and say, no, you are the one that sold this. You got to fix this problem. So you want somebody that's following through on those promises.
Thanks so much, everyone.
Excellent presentations. Anybody have any questions? The mics are there. Go ahead.
Thank you, guys. This has been really awesome. I'm in a DPC down in South Florida. shameless plug, we think the soil is extremely ripe in the Fort Lauderdale, Miami for change like this. Looking for someone who is willing to get boots on the ground down there. My question is in regard to physician involvement, both pre and then during the transition process for employers. And so, you know, I would imagine, as you guys have explained, it's a lot of energy explaining, and I know that oftentimes physicians are involved in that explanation process. How often do you meet with the employers, only you? How often do you meet with the physicians to make sure everyone's on the same page? And then how often do you meet together with employers to kind of rehash things and make sure that you continue good momentum?
I'll speak for us. We invite the DPCs to all the meetings, how as involved or uninvolved they want to be. Typically, there's a couple meetings initially so the employer understands the process. We always encourage do this at least 6 months before their renewal, because if they're 60 days out from their renewal, they just don't have enough time. But again, if the DPC wants to be involved or just, hey, just let me know when the patients are coming, we can definitely do that. It's typically going to be once the plan is in place. But again, as involved or uninvolved, the DPC, we invite them.
I would add to that, you know, the number one, if you were going to measure one thing with an employer plan in partnership with a DPC, the one thing I would measure, if you forced me to measure just one thing, it would be participation through the DPC. So the amount of employees using it. So with that in mind, one of the strategies, I don't know if there's one right way, but one of the strategies we did was even 6 months while the clinic was being constructed, we had DPC come in. We would have them at our summer picnic, at our Christmas party, at our, we would have, once the clinic was done, we'd have new hires tour the clinic. Ours happened to be on site. Near site, you could do the same thing. We wanted them in the clinic and comfortable for their pre-hire drug screen. So meeting the staff and seeing the facility and how nice it was and so forth. And so the more you can get them in there, then it becomes more natural for them and it becomes kind of theirs.
So as a doctor, you know, the whole thing is about control and choice for our patients to choose the healthcare and spend their healthcare dollars the way they want. So one of the things that I'm always having a hard time with is I want of course, people to join my clinic, but I don't want to limit the patients of that business to say that this is their doctor. So do you guys work with, like, on your thing to be multiple DPC clinics? Is it, like, how many choices do patients get, or am I just not thinking correctly? And it's okay to be like, no, this is our thing, this is what we should do.
Yeah, I'll try to speak to that some, because we did some unique things when we offered ours. We actually had a DPC pediatrician was in our community that we pulled in when we went to our employer. We had another DPC in a community near us that we pulled in and basically offered multiple areas, so there was a little bit of choice, which is always helpful. And I don't know if you were here earlier when when Dr. Hipkiss was talking about, she has 4 different locations to help a little bit for employers. I'm not saying you got to go open up 4 locations, but I think choice is huge. But if you're the only DPC in town, you are the choice. You're the best choice, right?
Right.
And so I'm a fan of trying to offer choice, and as you continue to grow, like if you get a partner, yes, you know, if you had a 500-man company, 500-person company join you, you probably need a partner tomorrow. And so then there is some choice there. So there are bigger companies, like in our neck of the woods. BMW has a massive, massive plant, and they're building a brand new plant. So it's like a small town. They have their own clinic. They have their own PT, their own doctors, their own pharmacists. They're not forcing their employees to go there, but it costs them nothing to do that. And so you're giving them a good option. And as Matt would probably tell you, he just said, the value of the plan, he knows if the more people they can get into DPC, the better the plan will be. And so they're going to offer usually an incentive to push people towards a DPC plan. Now, they don't have to pick you. There's usually another option. You know, you can go another option where you have a copay or deductible to see whoever you want. That's the way our plan works for the big employer we work. They have a DPC plan or a standard plan, and they can choose one of those options. So there's choice there. But employers typically, when they write a plan, they would very highly encourage people to consume the DPC, and it takes education. You have to go to the employer, you go to all the meetings, you go to the meetings with the employees and let them see who you are. We took our whole crew of 5 docs when we went, and so everybody could see who we were and what we were doing.
Remember, the traditional insurance model, the employees can choose often between a PPO and an HMO. HMO is cheaper, so a lot of times they'll choose the HMO, and the HMO completely removes all their choice. You know, there's only a select few PCPs they can pick, and then if they need a specialist, there's only 1 or 2 on the list in each specialty. So even in a huge city like Houston, where I practice, as soon as that employee chooses an HMO, they've relinquished all choice. So don't feel guilty about that. You're providing them a better only choice.
The other question I have is, so there's so many different people. Would you guys would be willing to like travel to where we are and just do like a presentation to like you and maybe other people? So
if you've
like
got the money, we got the
employees?
time.
All right.
Yeah, I'll answer that. So we work with DPCs all over the country. We will help anybody with any company of any size that needs help and advice and guidance, whatever help you need. If we can help, we will do that.
Thank you. Thank you. I don't know if this is on. Hello? Sorry. Hello? I actually have a 2-part question, and one is a follow-up to hers, is what if you get that employee that you don't want and you want to fire them? Now do you kind of leave the employer, you know, you have this one person that's not eligible for the plan because we don't want them. I had an employee once that was like sexually harassing. I obviously had to discharge them, and I didn't know how much information to tell the employer. But I was like, this is not a good fit. I don't want your employee, but I want all your other employees, right?
Yeah.
So that's one issue. And then the other is we've had a number of businesses that seem like revolving doors. Their employees are coming, going, they're sending us messages. We fired him today. Oh, we got a new one. And then I'm left with outstanding balances of the fired employee. I'm sending out certified letters. Hey, just to let you know, you have been fired, and we'd like to keep you. Like, please finish your outstanding balance. Do you want it? And so I feel like sometimes these revolving doors are bogging us down as well.
I can chime in just, I think the first part about the troublemaker, the person, the employee or member that is employed is through the employer, but maybe is not acting accordingly. So I think I would I would treat that as almost like an employee issue. You could even be a member of their family, so it's talking with that person. If it happens to be their family member, same thing. Is like, this is a benefit offered by us, so it's actually through the employment process. These are our values or whatever is being broken, and coaching that person and setting expectations to say, this is a great benefit we're offering, but you have to show respect and so forth, or you're not, I don't know what the consequence, maybe it affects their job, maybe it's, you're not gonna kick them off the plan, because that wouldn't be, but it becomes a job performance almost issue. If it's a member, yeah, great question, but I would handle it through the employment process and say, if you're gonna come to this clinic just like anyone else, you need to be respectful.
Well, the way you set up the plan is also very important. With RBP, you're paying anybody. So that employee can still go to any other doctor they want to within the plan, because the plan will pay that provider. They're basically showing up as cash. So there's not a scenario where they're out of luck now. They have no access to a doctor. Regarding the revolving door, again, it's how you set up the plan. What we do with our plan, we run it just like insurance. So if they're on the bill the first or second of the month, they're on the bill the whole month. So that eliminates if somebody gets terminated mid-month or end of the month. If you provided care, you're getting paid for that entire month.
I'm not so sure it's like the billing and things. It's more of like, is there industries? Like, is it the fact that I chose a restaurant industry and they have revolving employees? Like,
Correct.
If you're clear from certain industries, should we target certain industries?
Definitely restaurants have a high turnover, so keep that in mind. You also want to service the community. You don't want to just say, well, I only want the ones that, pay their bills every single month. You want to be that provider that's helping everybody. So that's up to you, right? Maybe not focus on them, but don't turn them away. But just don't say, we're not taking restaurants at all, because then it'll seem like, well, where are we going to go now?
I'll tell you how we do it to your first point. If someone's abusive or, a patient that doesn't need to be, or treating our staff bad, whatever, they're gone. And I'll call the employer and I'll tell the insurance folks, whoever the advisor is, you figure out what you want to do with them, and they're not coming back here. So that was one of the first things we had a discussion is when we met with our large employer. If somebody acts out or is bad, we're terminating them from our office. You need to figure out what you're going to do with them. Now, our employer plan, they have two plans. They have a standard plan and a DPC plan. We're lucky because we have multiple DPCs. They could try a different DPC clinic and see how that works, or they can kick them over to the standard plan, which means they go find their own doctor. So that's how we operate it, but we don't put up with it. Another thing quickly you'll need to decide is when you get a large employer, you're going to have people that are come in, you're sort of have to take who they send you, right? So you potentially could get people who are on chronic pain meds, chronic anxiety meds, or a combination of both that you don't feel comfortable with, and you need to figure out how you're going to handle that. That needs to be done up front. Hey, can I refer these people out to a pain specialist? I don't feel comfortable. You just need to have that conversation up front about those people and what are you going to do in your community. Maybe there's somebody better in the community that can handle that to save the company money.
Hi, I'm Jonah Hernandez. Thank you so much for giving us all this information. Also, special thanks to Shane Purcell for writing the book that helped me kind of come up with different ideas on how to present selling to employer groups. I did attempt to do one deal with a particular business. They were under 50. What I was challenged with was the CEO was very favored towards Mayo Clinic. We've got the Mayo Clinic in Jacksonville, Florida. When you walk into it, it looks like a 5-star hotel. It's like lipstick on a pig. Still the same system, but part of the business and the employees were in favor of the DPC practice, and the CEO, still wanted that connection and access to the Mayo Clinic, and that's where I lost the deal. So I'm wondering if there's anything that you have come across before in the past where you do have employees that still want to use their existing the Mayo Clinic and everybody else wants to use DPC and DSC. So not sure of how that works out for the self-funded plans along with the DPC plans, how you split those, how you give choices to employees, but maybe you can highlight on information that you've used before in the past to give me guidance.
That's the beauty of reference-based pricing. I always kind of use it as a joke and say, you're showing up with the wad of cash in your hand. If they see a pile of money and you're saying, I need care, they're going to take your money. And that's what RBP allows you to do. You're showing up as a cash patient. How much does a Mayo Clinic charge for this? The TPA will pay them either over the phone before the service, or if they want a check, we can mail them a check. Most of the time, at the time of service, we can just preload a debit card, pay them right over the phone. So they still have the opportunity to go anywhere. In our benefit guides we put, you can go anywhere for anything, but of course we highlight the DPC and the benefits of it, but employees have all the choice they want.
So the challenge for me was the primary care, right? DPC was the forefront, but they still wanted to see the primary care at Mayo Clinic. So same thing. They get the debit card and they can use that at Mayo Clinic is what you're saying, right? Okay, got it.
Back on that, the way I did it was I haven't done RBP, I haven't done reference-based pricing, but more of RBC, reference-based contracting, so pre-agreed payments. So in the plan design I did and I'm doing today is like a 3-column out-of-network, in-network, which is a preferred hospital, which in that case could be Mayo, probably not affordable, best cost hospital, and then a free column, which is your preferred provider, which the DPC falls in. So in our design, you could go to one Tuesday, you could go over to the free side Wednesday, back to the cost side. So if you use the old school hospital, you have your old school deductible, copay and coinsurance, et cetera. But so it's a daily choice by episode of care. Now what's required for that is either belonging to an independent network, if one exists in that area, where you could just sign up with that network and have a pre-agreed price with the hospital, or just talking to the hospital directly. Maybe it's one employer or group of employers and saying, we need a direct contract to work with you. And you can't do that with a BUCA because they're going to say you can't shop, you have to use our network only. But you can do that within the same plan, either or. But that's probably out of the DPC scope. Some DPCs are even getting into advisement and other things, but that would be more like an advisor or an internal champion within a company that's a little savvy at that.
Hi, so I'm John Sanders. We run Voyage clinics in Utah. Been open about 6 years. Got like 15 to 20 local companies. The local companies they're small, right? So, and they're like 70% of our market share. And so, are we doing anything to kind of network together to bring the reference-based pricing (RVP) to those clients? I mean, the big fish with the self-funded, yeah, but can we conglomerate under one roof for these smaller shops to provide kind of a product for them?
Yeah, so that's a great question. So in most states, companies of all sizes can essentially self-fund. There's a little bit of a different structure of self-funding called level funding, and the simplest way to explain that is it's self-funding for small companies. So in our agency, we have companies that have 2 people, 3 people, 5 people, 10 people that are all essentially self-funding. So it can be done really no matter what size you are.
So in the reference-based pricing, I've already bird-dogged like awesome pricing in my community for most folks. And most of my companies have plans actually. So they have insurance, and most of my clients have insurance. So, but they can't take advantage of both, right? Because they're not reference-based pricing. So I'll get them an MRI for $350, and if they use their insurance, you know, they would have paid $600 for just the deductible. So I just struggle with like that space, and how do I'd love to bring them to where that counts toward the deductible, or, you know, works toward their plan.
Yeah, so what you want to do is you want to help those employers that are using the BUCA health insurances and coupling that with your practice. You want to help them understand there's a different way to do your insurance, right? You don't need the Blue Cross network or the United network. You can actually remove the network completely, and now we're able to actually have those great cash prices that I send all of your patients to run through the insurance.
And one side point real quick about that is when they have a traditional plan, typically whatever they pay cash out of network won't count towards your deductible. So that's where encouraging them will just let it go because they're holding you back may help them give them that push.
Last question.
Thank you. We're about to open next month, and so we don't have any business contracts, but this really interests me because I've done some employee-based health care, primarily through the paper company where we used to do all their employees' physicals. So moving back into this, you know, they're the first business I want to go attract, and they have around 100. When you sell this to them or present this to them, does everyone, I mean, if this company says, we're in, we want you, we'll do this, does the employee then have, I mean, if 75 liked me but 25 liked their old doctors, I mean, do you split it, or is it when you sign the contract, it's your employees?
I think the answer is it's all how it's set up. So there's cases where the employees pay half the premium and there's different plans and they could choose in or out. There's cases where the way we do it, the way I've done it, is that the company would pay the full membership for the employee and their family members. So that would be a free path, no cost, even crutches, medications, anything done at that clinic and beyond at a preferred provider is free. So you do have the flexibility within a self-fund plan to design all that, and of course then that's where that internal champion, somebody who's passionate about it within the company, doesn't matter the title, could be the owner, CEO, HR, and then probably, depending if an advisor is involved, somebody that can help design those things, but it's not set in stone. With a fully insured plan, you're pretty well set. Here's the way it is, here's where you're gonna go. Self-insured has a lot of flexibility.
And we do it the same way that Matt does it. We help the employer understand why the DPC membership is an investment in physically increasing the health and productivity of their employee and their business, and also protecting all the money. So they pay 100% of the DPC membership always in our health plans. And if they don't do that, then the employees, if they make the employer, offer the employees like, we'll pay for a certain percentage of your DPC, but you have to pay for the other percentage. If they do that, the employees will not take the DPC. And then this whole strategy will not work. So it's very important to make sure that the employer understands why they need to pay 100% of the DPC. They can split the insurance with the employee, but do not let them split the DPC membership with the employee.
Yeah, that's what I want to know. And like, as I go into this employer in a couple months and I want to show them the data, how this is going to save them, is there a slide deck? Is there, a pamphlet? Or, I mean, how do I present this to
Did
the
Lee Gross
employer?
not present at this conference his slide deck that he always presents? Lee Gross has an incredible slide deck on all that.
Okay. All right. Thank you.
We'll get it to you.
Yeah, feel free to reach out to us too. I mean, we've got plenty of data from all of our clients that show, basically what I described. Like at every renewal, we have almost no claims activity, and we have great DPC activity, and that tells a story right there.
Great. Well, thank you to all our panelists. You guys were great. And take a quick break, and then I think we have a lunch program in the big room.